The U.S. labor market is experiencing a noticeable shift, as private sector job growth decelerated sharply in February 2025. According to the latest ADP National Employment Report, only 77,000 jobs were added, a stark contrast to the 186,000 jobs created in January. This is the lowest level of private job creation since July 2024, signaling employer hesitancy amid growing economic uncertainty. While wage growth remains steady, certain industries experienced notable employment contractions, and regional disparities widened. The report underscores the impact of policy uncertainty, consumer spending slowdowns, and shifting business sentiment as key drivers behind the hiring slowdown. This article will break down the key takeaways from February's ADP report, compare them to January's labor market conditions, and explore what these trends mean for the broader U.S. economy. The most striking feature of the February ADP report is the sharp drop in job growth. The 77,000 jobs added reflect a 58% decline from the 186,000 reported in January. In January 2025, hiring was broad-based, with most sectors adding jobs. In February, however, three major industries saw employment declines: trade, transportation, and utilities down 33,000 jobs, information down 14,000 jobs, and education and health services down 28,000 jobs. What changed? A combination of factors appears to be influencing hiring decisions: slowing consumer spending, as retail and logistics companies pulled back on hiring as consumer demand softened; policy uncertainty, with business leaders cautious about hiring amid tariff concerns and other regulatory shifts; and sector-specific challenges, where healthcare and education job losses suggest a structural shift rather than a cyclical one, potentially linked to funding changes or workforce reductions in response to higher operating costs. The ADP report also reveals a growing divide between regions in terms of employment trends: job gains in the Northeast, with 55,000 jobs, and the Midwest, with 56,000 jobs. Job losses in the South, down 12,000 jobs, and the West, down 27,000 jobs. The South's job losses were driven largely by South Atlantic states, down 26,000 jobs, and West-South Central, down 18,000 jobs. The West's decline, down 27,000 jobs, was heavily concentrated in Pacific states like California and Washington, where regulatory changes and economic headwinds may be dampening hiring. A shift in regional growth patterns? The Northeast and Midwest saw strong hiring gains, possibly benefiting from manufacturing expansion and infrastructure investments. The South and West, which were job growth leaders in 2023 and early 2024, are now struggling due to cost pressures, shifting demographics, and supply chain constraints. This regional divergence highlights a potential economic rebalancing, where previously dominant growth regions face headwinds while others catch up. Another notable trend in the February report is the job losses in small businesses. Small firms, with 1 to 19 employees, lost 17,000 jobs. There were slight gains of 5,000 jobs among firms with 20 to 49 employees. By contrast, medium-sized businesses, those with 50 to 499 employees, and large companies with 500 or more employees, added jobs. Medium businesses added 46,000 jobs, while large businesses added 37,000 jobs. Why are small businesses struggling? Higher capital costs? Rising borrowing costs and tighter credit conditions have made it harder for small firms to expand payrolls. Wage pressures? Large companies have more pricing power to pass on higher labor costs, while small businesses often struggle to compete on wages. Uncertain economic climate: entrepreneurs and small business owners may be delaying hiring decisions amid volatile demand expectations. If this trend continues, small business employment stagnation could weigh on overall job creation, given that small firms are historically a major driver of labor market expansion. Despite slower job growth, wages continued to rise. Job stayers saw annual pay increase by 4.7%, the same as January. Job changers saw pay gains of 6.7%, slightly lower than January's 6.8%. What does this mean? Labor market tightness is easing. While wages are still rising, the pace of growth is stabilizing, suggesting less pressure on inflation from labor costs. Job switchers are still benefiting. A 6.7% pay increase for job changers signals that employers are still willing to pay a premium for skilled workers, albeit at a slightly reduced pace. The Fed's inflation battle continues. With wage growth stabilizing but still strong, the Federal Reserve may see this as a sign that inflationary pressures are not yet fully contained. The February ADP report highlights a softening labor market, but it is not yet clear whether this is the start of a prolonged slowdown or just a temporary dip. Key trends to monitor in the coming months. Job growth recovery or further slowdown? Will the labor market rebound in March or will hiring remain weak? A third straight month of weakening job growth could indicate a more sustained economic slowdown. Impact of policy uncertainty. Tariff policies, interest rates, and government spending cuts could affect hiring in key industries. Business leaders may delay major hiring decisions until they see clearer economic signals. Wage growth versus inflation. If wage growth slows further, it could ease inflationary pressures and potentially lead the Fed to consider rate cuts. However, if wage growth remains elevated, it could force the Fed to hold rates higher for longer. Sector-specific risks. Healthcare, education, and transportation job losses could signal underlying weaknesses in these industries. If retail and logistics hiring continues to decline, it may reflect weaker consumer demand and a broader economic deceleration. The February 2025 ADP report paints a mixed picture of the U.S. labor market. While job growth slowed sharply, wages remained steady, and regional hiring trends diverged. Employers appear increasingly hesitant to expand payrolls, reflecting uncertainty over economic conditions, policy shifts, and the future direction of consumer demand. Going forward, the March and April reports will be critical in determining whether this is a temporary hiring slowdown or the beginning of a more pronounced labor market softening. For now, the U.S. labor market remains in transition, with employers, workers, and policymakers closely watching for signs of what comes next.